Alright, welcome again to another video on how to secure yourself financially. And here, by jumping straight forward to the cash flow statement, one of the four financial statements, which after all, a financial statement, it shows you the money. In this section, I'm gonna learn, or I am learning, is how to read basic part of financial statement. So if you're able to read nutrition labels or baseball or soccer box score, you can learn to read the basic part of financial statement, and if you can follow a recipe or apply for a loan, you can learn the basic of accounting. And the basic, they're not difficult, they're rocket science. So much like a CPR course, okay, so where you perform basic cardiopulmonary resuscitation, this will teach you, or in this section you're going to learn, is how to learn the basic part of financial statement, how to read that. So much like a CPR course won't train you to be a cardio doctor, this section won't train you to be an accountant. However, it can give you some confidence when you're able to see a set of financial statements and make sense of that, which this is exactly what I'm doing here. So the TLDR of this balance sheet or this financial statement is the balance sheet show what a company owns and what it owns at a fixed point in time. The income statement, how much money a company made and spent over a period of time, as well as the cash flow statement, show the exchange of money between the company and the outside world, as well as the statement of the shareholders that show the change in interest of the shareholders. All of these financial statements are based on period of time. So you have quarterly, annually, you name it. So just to jump straight forward to the cash flow statement, which is it reports the company inflow and outflow of cash over a period of time, that it reviews some of the information from the balance sheet and the income statement. And the cash flow is something important to, because much like people, company need to have cash to pay this expense or to purchase assets. So this statement, the bottom line, show the net increase or decrease in cash, and it's generally made of three parts. You have operating activities, financing, and investing activities. So the cash flow statement review the cash from one of these activities. So operating activities involve, which is the first part of the cash flow statement, it involves looking at the net income from the income statement and conciliate that with the total amount of cash that was used or perceived from other operating activities. And the most common operating activities is operating assets and operating liabilities, where the most common operating assets are accounts receivable, inventory, property, plant, and equipment, prepaid expense, such as premium insurance, like health for medical coverage, home or vehicle to protect those belonging in the case of any accident or someone thief, for example, your vehicle. Long-term liabilities in the case of lawsuits. Life, such as protect you or protect in this case in the event of the policyholder's death. Disability, that prevent you from working, or long-term, such as home health care or nurse home care. Marketing, rent, office supplies, software licensing, and software licensing and manufacturing maintenance contracts are another example of prepay expense. Intangible assets such as patents, which are exclusive rights to provide inventors so they can manufacture, distribute, and sell their inventions over a period of time. So just to mention the most popular patent, or the patent that changed the world from Popular Mechanics, a website, well, you have here is the maglev, the electromagnetic inductive systems for stabilization and suspension system, or these electromagnetic inductive systems for stabilization and suspension for ground vehicles. The maglev, which is what, as the patent name suggests, or as the patent name mentioned, this was issued in 1969. GPS, this navigation system using satellites with passive ranging technique, issued in 1973. CRISPR gene editing, which it was issued in 2014. The iPhone, or as the patent name mentioned, or as the patent name called, electronic device, issued in 2007. So this is just a couple example of that. And then I also look at the copyrights, which are exclusive rights to creator of original works, so they can manufacture, distribute, and sell their inventions over a period of time, such as McDonald's, Netflix, Twitter, Spotify. Trademark, which are exclusive or unique designs, audio, words that uniquely identify this company from the competition. Trademarks with trade secrets, which are confidential data that a company used to gain some competitive advantage, such as process, formulas, or customer lists. Goodwill, which is the brand recognition and brand reputation, as well as the customer loyalty. And keep looking now at other operating assets, such as investment in affiliates, where this is a company that invests in another company to earn a return from that, or to gain competitive advantage, or even both. So joint ventures, a partnership between two or more companies to undertake a specific business activity or project, such as, or an example of that is Crocs and Post Malone. Equity investment, which after all, this is a company that may purchase significant amount of stakes on the another company, on the another company decision. Okay. So on the equity investment, come back here earlier. Yeah, I'm thinking a lot of things. So, yeah, equity investment is this is when a company purchases significant amount of stake on the another company assets to raise its voice and potentially influencing the another company management decisions. Here you have is Berkshire Hathaway, led by Warren Buffett, which is a multinational holding company that invests in different sectors like energy, real estate, or retail. SoftBank, which is a Japanese conglomerate that invests primarily in technology companies such as WeWork, Uber, Airbnb, Alphabet, the parent company, the Google parent company, where this invests primarily in technology companies through its venture capital arm called Google Ventures, where you have here Calico, this longevity company, Texas Pacific Group, or TPG, a private equity that invests primarily in real estate, healthcare, and keep looking at other joint ventures, limited partnership, where now a investors or a company purchase stakes on the limited partnership in return of the in return of the partnership assets and operations, as well as associate, where this is where a shareholders or a company owns around 20 to 50% of the share on another company. So with that, and I also keep looking at the cash and cash equivalent as another operating assets, where you have here money funds. This is to get fast liquidity, where now these money funds invest in very short-term debt financial instruments, such as bank acceptance, short-term debt issued by banks, certificate of deposit, savings certificate issued by banks with short-term maturity, commercial papers, risky and unsecure corporate debt, and repurchase agreement, short-term debt issued by governments. Now, with that, okay, then I look, all right, to other things. Then I look to other things like, so once I look at all of at least these most common operating assets, then I look at the most common operating liabilities, okay, such as accounts payable, money that you owe to the suppliers and vendors, usually in a short term, something around 30 to 60 days, such as raw materials, service, office supplies, accrue expense, so expense that a company incur for good and service that has been received but not yet paid for, such as wage and salaries, rent and utility bills as well, taxes, deferred revenue, future obligations that a company has to provide for good and service based on money that has been collected, meaning subscription service like Netflix, Spotify, where they have to provide, when they collect the money first, for example, a yearly subscriptions, and they must ensure these obligations to provide this service to their audience, to the customer. Gift cards is another example. Income taxes, income taxes payable, money that you owe to the government, to income taxes payable, money that you owe to the government. Income taxes payable. So this is money that you owe to the government based on your income and the tax rate. So you have your corporate taxes, such as in the US is something around 21%. Withholding taxes. Your employee deduct, or an employer deduct from its gross employee salaries a portion and pay that to the government. This is to promote the pay as you earn tax system, and also to fight tax evasion in the US. And sales tax, such as states or county or city, as well as VAT, value added tax, which is a tax imposed at every stage of the production of good and service, where the customer ultimately pay the full VAT. In business, along the supply chain, remit that portion to the tax. Excise, which is a tax imposed on specific goods like guns, gasoline, alcohol, tobacco, as well as GST, which is a good and service tax. Basically, that is on Canada, India, and Australia. And they also look at the short-term borrowings, okay, when company needs to meet their financial needs, or their working capital. Okay, this difference between the current assets minus current liabilities, and this is an indicator of one of the multiple indicators of the company's health, right? Where this show is if a company, the liquidity of a company and the short-term financial health. So then I look at the, how do you put it? The example of short-term borrowing, whether it's a bank or line of credit from companies, especially or when company issue is commercial paper to meet their financial needs. Trade credits, especially when you want to when a company wants to renegotiate, it is payments to vendors and suppliers, outstanding invoice. So based on their outstanding invoice, so a lender evaluate that and give specified particularly amount of money or a loan to them. Or, well, this payroll or in a payroll advance. Okay, so now this is company that give salary advance or payroll advance to their employees, and that will be deducted in the next payday. Okay, so that's great, you know, because with this short-term borrowing, I also look at something called notes payable, which is now an agreement between the borrower and the lender, where they create a promissory note describing all the terms and conditions of the loan, such as banks. Anytime when you ask a loan for a bank, it creates this notes payable. Outline is the principal, the original amount borrowed, plus the interest, as well as the repayment schedule and other details. For companies, where now companies go to financial institutes like private lender or venture capitalist, it creates this note payable as well. Trade payables, but now this is a renegotiation with your vendors and suppliers to repay them. Okay, bonds issued by governments, and issued by governments, and bonds issued by governments, and issued by governments or companies. Okay, when they want to raise capital, so it create is this notes payable. Outline is all the details. I just want to look at the thing here, which is because I think that's something very, very important. You know, this loan here. Is this. So you have bank loans, business loans, bonds, promissory note, where now this is to companies, okay, or individual or business that issue these promissory notes directly to lenders. Okay, and these notes outline the terms of the loan, including the repayment schedule and interest rate, making them notes payable. Trade payables and installment loans. Okay, so you have here bank loans. Okay, so bank loans, business loans. So banks loans, okay, is, well, anytime a company asks for loans in a bank, it generally is a notes payable, as well as the business loan. But this is when a company goes to a financial institution, such as private lenders or venture capital, they create this note payable. Bonds So bonds are debt securities. And if you remember, the term security is a financial instrument. Look at this. Security is a fungible, non-negotiable financial instrument that holds some monetary value. In other words, the term fungible is that it can be converted to other financial instrument. This is called security, right? So this is a security, a fungible, negotiable financial instrument that holds some monetary value. Okay, and such as bonds or stocks, for example. And what is a security?
We're going to start off easy with things that most of us are pretty familiar with. So we're going to start with the idea of what is a security. Most of us are familiar with the term, but the technical definition of a security is that it's paper traded for value, where a profit's anticipated through third-party management. Now, the two basic types that most of us know are going to be stock and bonds. Equity, or stock, is going to give a customer ownership in the security, whereas bonds or debt securities are going to give the customer loanership positions. We have other types of securities as well besides stocks and bonds. We also have mutual funds, variable annuities, which are considered to be securities, options, which are securities in their own right and derive their value from the underlying security, and we also have rights and we have warrants. Now, it's really important for the test to determine what's a security and what's not. So things that are not considered securities, if you see whole life insurance policies, those are not securities. If you see term life insurance policies, those are not securities. Fixed annuities are not securities. Now remember, variable annuities are, so you want to be able to make that distinction for the
fixed annuity are not security.
exam. IRAs and retirement plans in and of themselves are also not securities.
They are not security.
They're actually shoeboxes, if you will. And you put your securities into the shoeboxes, which would be an IRA or some other type of retirement plan. A prospectus is not a security because a prospectus is nothing more than a disclosure document. And a confirmation is not a security because your confirmation actually confirms that whatever trade you wanted executed was in fact executed properly. So again, for the exam, one of the questions you can see is, what's a security and what's not a security? When a corporation decides that they are going to incorporate, the first thing that they do is they go out and they hire themselves a lawyer. Now that lawyer is going to draw up their corporate charter. And in that corporate charter, they're going to address the idea of common stock. Now that common stock that they address will be in the form of authorized common shares. So the easiest way to think of it is that authorized common stock is stock that has been authorized for sale in the corporate charter. Now the registrar is an entity that's put in place or hired by the issuer to make sure that the corporation does not issue more shares than they've authorized in their corporate charter. Now remember, just because a company has authorized a certain number of shares doesn't mean that they have those shares actually in the public hands or that they've even issued those shares to the public. Authorized is simply what's on paper in the corporate charter. Issued stock is stock that's been actually issued to the public. So if the corporation decides that they're going to issue a certain number of shares, those shares will be in the public hands, and we'll say that it...
Okay, but this is important to recap about the security, what is security and what is not. And so IRA are not security. Premium insurance are not security. Because they are not this financial instrument that holds a monetary value. Fungible. I think this is a very important topic here. Fungible and negotiable. Okay. So most common type of security are stocks and bonds. So fixed annuities are not security. Variable annuities, on the other hand, it is. Interesting. Interesting. Okay, so because I'm looking here at the notes payable, right, which is an agreement between the borrower and the lender, when the borrower outline is the terms and condition uh, of the loan. Okay, so you have this bank's loan. So anytime you ask a loan to a bank, it generates a promissory note, or this notes payable outlining the principal, the interest, as well as the repayment schedule, right? And also you have this business loan, where here is companies that wants to borrow money from financial institutions such as private lenders, equity, or venture capitalists. Bonds, which are issued by corporate or government, where now once you for raise capital. Okay, so they represent is a promise to repay the principal plus the interest in a periodic time. Promissory notes are now issued, or are this promissory note is for individuals or business that may issue promissory notes directly to lenders. Okay, so unlike bonds, okay, which is now a certificate, the promissory note is something more. It's part of the nature, okay, but it's something that happens between this individual or business, where now they issue a promissory notes directly to the lender. We also have trade payable, when you're going to renegotiate is extend payment terms with your suppliers and vendors. Okay, so based on a previous agreement. In installment loans, when individuals or business borrow money for purchasing assets like vehicles or equipment, they may enter into installment loans agreement. These agreements specify the repayment terms, including the amount of each installment and the interest rate, making them notes payable. So with that, okay, which is something that I need to dedicate time to learn about it, as well as the warranty obligation, which is obligation that a company has to pay or to fix or replace a defective product or a product that doesn't meet certain quality standards. Okay, you have manufacturing, manufacturer's warranty, service, software, parts, vehicle. So with that understanding of the operating activities, I list the most common operating liabilities, all right, and see how the operating activity works and how they calculate that on the cash flow. Well, it analyzes and conciliate the net income from any non-cash items that affect the income statement where there is no cash involved, such as amortization and depreciations, or stock compensation, okay, as well as look at the total amount of cash that was used or perceived from other operating activities, okay. And then I look at the investing activities, which is the second part of the cash flow statement, and generally review the cash flow from purchase or sale of long-term assets. Long-term assets such as intangible assets, goodwill, property, plant, and equipment. I also look at here example of long-term assets. What happened? There you go. Okay. So example of long-term asset here is you have exactly property, plant, and equipment, intangible assets. So these long-term assets are resources that a company owns that are expected to provide value for more than 1 year. For more than 1 year. So you have property. It is funny because these long-term assets is, from the company perspective, is something that expect to provide some economic benefits or value for more than a year. Okay, so property, plant, and equipment, intangible assets, investments, goodwill, and leasehold improvement are a couple of these long-term assets. So if a company, for example, decide to purchase a property, that activity will be registered as an outflow of cash from this financing activity. However, if a company decides to sell some investment in their portfolio, this operation is registered as a cash inflow because cash was received from the operations. Okay, so cool. And then, so just to remember about this now, payables and long-term assets. So long-term assets are things or resources that a company owns and expect to provide value or economic benefits for more than 1 year. So property, plant, and equipment is an example. Intangible assets are another example. Investment is another good example. Goodwill and leasehold improvement. Long-term receivables or loans, owns that by a company, typically exceeding 1 year. So property, plant, and equipment, intangible assets. Property, plant, and equipment, intangible assets, investment, goodwill, long-term receivables, or loans that you give, or loans that you own from others, long-term receivable, and leasehold improvements. So improvement made to leased property, such as renovations, alterations, or additions to better suit the company needs. Okay. So that was very, very easy to grasp, but for at least the investing activity. And then I look at the financing activity, which is the third part of the cash flow statement. So it reviews the cash flow from the financing activity, and typically source of cash flow include cash raised from borrowing money, from borrowing from banks, or selling stocks and bonds, as well as pay back a loan will show up as a cash flow. So that'll be all for this video. Take care. Bye-bye.